think it's fair to say that we all expect payments to be secure. I obviously don't want someone to steal money from me, but at the same time, I also don't want to be frustrated by having a transaction declined when I'm trying to make a payment. And whilst fraudsters are becoming more and more sophisticated, at the same time, we all want our payments to be more seamless and more frictionless. So how can fraud prevention walk this tightrope? That's what we're going to uncover in this episode of Navigating Digital Payments.
Welcome to the Navigating Digital Payments podcast, brought to you by Worldline, bringing you the latest innovations, trends, and predictions about the future of payments.
Hello and welcome to this episode of Navigating Digital Payments. I'm David Daly. I look after the Discovery Hub here at Worldline, and I'm really delighted to be joined by a fantastic guest who is a real expert in fraud prevention. His name is Alex Zeltcer, and he is the co-founder and CEO of nSure.ai. Hi, Alex. Welcome to the podcast.
Hey, David, and thank you very much for having me. It's a pleasure to be here.
It's a real pleasure to have you joining us. So later, I really want to get your predictions and thoughts on how fraud prevention in payments might change and evolve in the future, what some of the dramatic adjustments might be. But first, perhaps you could tell us a little bit about the story behind nSure.ai. So what led you to create the company?
Sure. I think like many other startup companies, we discovered a problem, and we discovered it in our previous company. Our previous company was a company called Zeek. It was a marketplace for gift cards, digital gift cards. And we had no idea how difficult it is to sell digital gift cards online. We started the business. We actually started it in Israel, and so absolutely no fraud. It was great for a few months. We launched in the UK. And we were hit immediately with massive amounts of fraud. The reason, by the way, is not that UK are more fraudsters than Israelis. The issue is that new Israeli shekel gift cards are not very liquid, as opposed to an Amazon COUK or a Tesco gift card, obviously. So we were very surprised. We were very happy on the first week because in the first week we ran out of inventory. Right? We bought the inventory, we ran out of it. The week later, we realized that 40% of the sales we've made were done by fraudsters, which means we got chargebacks for 40% of the business. It's a business where the margins are best case 4 to 8%. Losing 40% on the first week is not a good thing. We realized that we clawed down, we shut down, and then figure out what do we need to do in order for us to go back to trading. We did that with heuristics and various rules, and used whatever was out there from a tool perspective that would allow us to start trading. And we did that, and it took us a very long time to realize that the tools are not efficient enough, and goes back to the topic that you've mentioned. It's that balance between approving enough business versus not gaining too much fraud. Right? That's the balance we need to look at. And we found that we were declining more than 25% of the orders. And when we looked at the new shoppers, we were declining closer to 40 to 45%. When you look at what it does to your customer acquisition costs, which is basically doubling them, it's insane. It's no way to run a business. So pretty early on, we decided to invest in our own tools to improve with time. We realized that the only way to go is machine learning. It was pretty early on, but my co-founder and our CTO Ziv had come on from a company that did natural language processing and was sold for Intel. He was very well versed in machine learning. We started our own models, and probably 4 or 5 years into it, realized that the problem we've identified is not only a problem for us, it could be a much bigger deal than the entire marketplace we've been. And at the time, the marketplace was pretty big. We've been doing about 100 to 120 million a year in our revenue. But on the other hand, the fraud prevention piece, we realized what we've built was so much stronger than what the tools out there were able to provide. We decided to look into what kind of market size, what's the total addressable market for a technology such as this, realize that it's massive, and decided to spin it out, brought in external investors, acquired the team and the technology, and that's how nSure came to be. Actually, in at the beginning of 2019, and we've been improving our models and deploying them with clients ever since.
I guess it's interesting because you talk about how you found the problem, but it's two steps, isn't it? Two problems. The first problem is a high level of fraud. The second problem is then to try and prevent that fraud, you actually end up declining a large number of transactions. And I guess people are just abandoning then the sale. They're not going to the trouble to try a different card or a different payment method. So you lose a lot of business that way. I'm really intrigued in a minute, Alex, to hear how you applied AI to the problem and what sort of results you got. But maybe first it's just worth you clarifying a little bit. I mean, what is the goal when you're trying to detect fraud? What makes good fraud detection?
So obviously it's a big question, and there's no single answer to it, and it varies in different industries, right? So first of all, the problem we're solving is the merchant's problem, right? So, and that's an important distinction. What most of the audience may not be aware of is that the problem when someone is using your credit card information, when someone steals your credit card information and is using that to buy online, the merchant is left with the chargeback. It's not the banks that need to take care of that. It's not the issuing bank or the acquiring bank. It's really the merchant. That's the first thing that people need to understand. And the second thing is that it depends on the kind of merchant, the level of risk that they encounter. The reason for that is that if you think about physical goods versus digital goods as a first distinction, there's a huge difference. Say you're a fashion merchant, you're selling shirts and shoes. Since the problem is on your side, until you've actually left the shirt or the shoes on the consumer's doorstep, you haven't lost anything. So if you take the transaction today and you deliver tomorrow, you have a day to reassess the risk and decide whether to fulfill that transaction or not. If you decide not to because the risk is too high, nothing happened. You didn't get the funds, obviously, but you didn't lose the product. So no harm. In digital goods, it's very different. For instance, with digital gift cards, right? Once you've delivered someone the number that is the digital gift card for Tesco, it's gone. The value is gone. You can use it immediately and that's it. So you don't have a day to reassess the risk. You have to decide now. And that makes a very big difference from two perspectives. Number one is most of the payment fraud prevention platforms are used to having that time to reassess the risk, and therefore the risk profile is very different. And therefore, as a result of that, they see the risk as much higher, they decline more. That's problem number one. Problem number two is way bigger. Problem number two is from the fraudster's perspective. Because the fraudsters are looking for ways where they can perpetrate fraud at scale. And these type of products, the digital products, they attract the fraudsters that are doing that at scale. And when you put yourself in their shoes, who are these fraudsters? What's their process? What do they do? So the first thing they do is they go on the darknet and they buy a list of stolen financial instruments, a list of stolen PayPal accounts or credit card accounts or bank accounts. They don't steal them themselves, right? It's a different kind of fraudster that attacks the banks and gets their hands on the list. It's a fraudster that buys that from them. And they paid $10 to $50 a line, right? Every credit card costs $10 to $50, depending on the credit, depending on many different aspects. Now they need to turn that into more cash, right? Because if they don't make more than $10 per line, then they're not a very good business. And that means that they need to use that credit card to buy things and resell them. That's what you do with a stolen payment instrument. So imagine the difference between buying and reselling 1,000 shirts or 1,000 iPhones and buying and reselling 1,000 codes for a game on Xbox or 1,000 Tesco cards. It's, clearly that's a very different operation. As a result of that, the fraudsters that do that as a business, they find it much more lucrative to attack sites that sell these type of products. As a result of that, these type of merchants are faced with a significantly higher risk. And these are products that basically adhere to two elements. Number one is they're delivered immediately. Number two is they're liquid. That's it. Once you have this combination, it's a paradise for the fraudsters. And this is true for prepaid debit cards, it's true for gift cards, it's true for plane tickets, it's true for cryptocurrencies, it's true for game codes. These are the types of products, and we at nSure, the only thing we do is we deal with fraud for these type of products because that's where we found the industry lacking. The industry does a great job for standard e-commerce, a great job, and it does a very poor job for these type of products.
It does somehow remind me of the fact in Worldline we talked a lot about hyper-automation and applying AI to automation, but one of the starting points is that it becomes easier to automate things once they are digitalized, and that's kind of what you're saying here. It's much harder to sell 1,000 shirts, or it's far harder to automate the selling of 1,000 shirts than automating the selling of 1,000 game codes or gift card codes, as you say. And it also acts as a reminder, I suppose, about how industrial fraud is becoming. I mean, this is no longer one person stealing a credit card in one shop and then...
But it's a business. It's a business with return on investment criteria.
And some people may find that quite shocking if they didn't realize that that is already the case. Just the scale of kind of the problem that's being faced there is quite immense.
Yeah, if you look at the numbers are staggering. The size of the problem, by the way, when we look at, or the industry looks at the size of the fraud problem, it's not only the chargebacks themselves, that plus whatever gets declined, right? The legitimate shoppers that gets declined, we call these false positives, right? Plus, beyond that, everything that has to do with the people and tools you put on solving the problem, right? Or the investment you make. This is today hundreds of billions of dollars. It's coming on trillion. Entire e-commerce today is roughly 5 trillion. If you add to that the financial payments industry and crypto, etc., maybe you get to 10. It's a 10% problem. That's the size of it's staggering. It's staggering.
So I'm then interested to hear, when you first started applying AI to this challenge, then what were some of your early findings or discoveries when you began tackling it?
So it's an interesting question, and the initial foray into fraud prevention, in the late 90s when e-commerce started, was all rule based, right? It was machines that had different rules. If your IP is one country and your phone is a second country and your credit card was issued by a third country, then decline, right? Something like that. And it evolved to identity verification. And what we've realized is that in the digital world, identity verification fails. So the common sense is, if you make sure that the person behind the scenes conducting the transaction is the rightful owner of the credit card, then you're in good shape. Right? Because then it means it's his credit card, he's authorized to conduct the transaction, everything's okay. And it makes sense to a certain degree. What happens in the digital world is problematic from a couple of perspectives. I don't know if you're a gamer or if you play on Steam or on Xbox, but let's assume you are for a minute. And I don't know if you purchase cryptocurrencies, but let's assume you purchase on Coinbase occasionally. And I'm sure you're an Amazon client, right? I think we all are to a certain degree, right? So your email address when you're using Amazon would probably be firstname.lastname@gmail.com. Like 90% of the population would be that. When you play on Steam, it's going to be a very different email address. It's going to be an avatar of some sort. You're definitely not going to disclose your first name to anyone. When you're doing transactions on Coinbase, you're using a third email address. One that no one knows, no one has access to, that maybe you never even get into, and except for answering questions by Coinbase. People get very, very careful about that type of information. And then what happens if you query for that information as part of your fraud prevention techniques, and you're from the e-commerce world, it creates false positives, because you'll identify a fingerprint on the device, and you'll know that the email address associated with it is firstname.lastname@gmail.com, but what you get on Steam is different. Then you say, no, that's a problem. Let's decline that transaction because it seems like someone is messing around. Has nothing to do with reality, and worse than that, in the digital world, it's bound to happen. It's bound to happen. So the first thing you need to realize is that it doesn't work. It's even worse than that. If you think about, the strongest tool in our arsenal when it comes to identity verification is what the industry calls KYC, know your client protocols, right? It's when someone asks you to take a picture of yourself and your ID card together and match, do face recognition or whatever, and match them. These are KYC processes. These don't work. These are required in financial institutes. These are required in cryptocurrency exchanges, etc. Based on the statistics we've seen with our clients from these domains, more than 70% of the fraud comes from accounts that were fully verified through KYC. And the reason for that is that it is so lucrative for the fraudsters. They would buy such accounts. They would buy such accounts for 100, 150 bucks after they've gone through KYC. Then they would use them to commit fraud. It makes sense. One 1,000 transaction in the crypto world is nothing. You paid $150. You made your 80% margin, and you go elsewhere. And you can do that at scale today with mules, where you'd hire people to create these accounts. So identity verification doesn't work. Now, how does that relate to AI? It relates to AI because of what do you need to do instead of it. And what we found is that the only thing that really works well, at least for us, is behavioral analytics, is behavioral analysis and identifying behavioral anomalies. And I'll give you an example. So let's say we're looking for scalable fraud attacks, right? For the cases where the fraudsters are really organized, they have a machine, it attacks your site. It's not a person that is, playing around with a browser or whatever. So we're looking for massive attacks, very similar to distributed denial of service from cyber world. So let's say we're looking at how long it takes you to take a decision on whether you want to buy an Amazon gift card or a Tesco gift card. And we see a person coming in and it takes them 12.5 seconds. There's not a lot we can do about it. Looks okay. A second later, another one comes in and they hesitate for 12.5 seconds as well. Exactly. That's interesting. On the fifth or sixth, after 3 or 4 seconds, you can say, okay, I'm recognizing a pattern. These people, even though they come from different IPs, different countries, different payment methods, everything, they seem to be linked by their behavior. It seems like they're a group, and we can say, okay, now let's stop it. Now the velocities of our engines would kick in, and we'd say, okay, let's stop that. But in order to do that, you have to look at hundreds of thousands of such parameters. Now, you can't look just at how long it takes you to decide on one element or another. You have to look at everything people do. And to do that with rules is simply impossible. It's too complicated. The only thing that is able to do that is driving all of these massive amounts of data through machine learning engines, train them based on that to identify the patterns, and then be able to recognize that in real time. And basically that's I don't think we're the only ones that are doing that. There are other companies in the world that are specializing in such algorithms or in such ways of identifying anomalies. But that is what's really working well today for fraud prevention in the scalable fraud patterns that happen for digital goods, for risky goods.
I think what's really interesting hearing that, though, Alex, is that a lot of AI is essentially pattern recognition. If I hugely oversimplify, I'm sure my AI colleagues will hate me saying that. And of course, I've had discussions before with other fraud experts actually at Worldline, talking about the fact that sometimes what you do is you predict the expected behavior, and then something that doesn't fit the expected behavior is the anomaly. Or sometimes you try and predict the anomalies. So you try and predict the fraudulent behavior, and if something matches that pattern, it's fraud. But what you described there is subtly different in my mind, in that it's still essentially pattern detection. But what you're doing is you're looking at a lot of data and seeing if a certain number of transactions look somehow similar, like they're following the same pattern. And you don't know in advance necessarily what that similarity it is. So you could never configure a rule saying if it's 12.5 seconds.
Exactly. You cannot do that.
Because it might be 13.5 seconds. It might be 11 seconds. You don't know. But what the AI algorithms are doing is looking for behavior that is suddenly similar and recurring and saying, well, that could be fraudulent. So I think it's as I say, it's still essentially pattern recognition, but pattern recognition can be used in many different ways. And that's quite fascinating to hear.
You take that further, it's the issue is that if you would be looking at 3 or 4 such elements, the fraudsters would identify that and would circumvent it. The only way that you can be ahead of the curve is by looking at a much broader picture that makes it almost impossible for them. You cannot randomize everything, right? Or maybe you could if you had infinite amount of resources, but they don't. So at the end of the day is your ability to look at a wide enough picture that would identify that, and it works really well for our world, right? There's no reason for doing that in e-commerce. If you do that for e-commerce, you're going to fail because you wouldn't see rings attacking e-commerce sites. There won't be that similarity between the different behaviors because it'll be a person sitting there and clicking his keyboard. You won't see that. But when you look at a crypto exchange, when you look at a neobank that has a wallet, when you look at someone selling prepaid debit cards, these are going to be attacked by machines constantly. The second you open up such an account, it's like putting up a sign in the dark net and say, "Come get me. Let's see if you can." That's what happens. It makes sense in our domain. It doesn't in others, which is what makes us and companies like us very different when we are focusing on a specific domain.
And that in itself is also, because we used the word industrial earlier, didn't we? And I guess you're right, this kind of technique, it works when the fraud being perpetrated is being done on a somewhat automated industrial basis. I'm interested as well because you're based and your company is based in Israel, but you serve clients in different geographies. Do you see is it the same everywhere, or is there a variation in the kind of challenges and the approaches you have to take?
So there are differences in regulation. So there are definitely differences. First of all, fraud comes from everywhere, right? So even if our client is a US based or a European or someone in Asia Pac, it doesn't mean that fraud would come from the US or from Europe, right? The fraudsters would come from wherever they want to come, and it's very easy today to through VPNs and whatever, regardless of your proxy pursing technologies or and all of these buzzwords, it's very easy to fool everyone. If you wanna look as if you're coming from the US, it's very easy to do that. So it's not about where the different bad players are coming from. It's more about what do you need to do in order to detect them, and how does regulation look at that? So in Europe, we have 3D Secure and strong customer authorization that has came into play, last year and has made a difference. In our domain, we see that it does help in taking liability of the merchants, but it doesn't really change the fraud. The fraud level remains the same in our industry, so it's not very helpful, but it is different in the way you need to react to it. If you look at the US, for instance, 3D Secure, once you deploy 3D Secure for a US merchant, his sales drop by more than 50%. So the next day he gets rid of the 3D Secure and looks for something else. If you look at at India, for instance, if you don't have 3D Secure, people will not buy from you because they're worried that you're not safe. So there are consumer behaviors that change, and as a result of that, your techniques on identifying fraud need to adapt. So we're seeing various behaviors in different countries. So because of the high velocity of goods we're seeing a lot of arbitrage opportunities. There are arbitrage opportunities in currency exchange. Even we've seen Nigeria and Argentina, for instance, in the last let's say year or so, has seen very different rates from the central bank than what you can get on the street. As a result of that, sometimes it creates an opportunity to go through that arbitrage when you're going through different currencies, or when you're going through crypto, or when you're buying top-ups from mobile. And people are using that. Once they identify that, they're using that. So you have to be aware of these patterns as well and understand whether that's hurting to your merchant or not. Sometimes it doesn't. And then the merchant is happy that happens. Sometimes it does, and then he's very unhappy that it happens. So there are, I would say, in our industry, it's regulation that comes to play and is different in different geographies. It's consumer behavior that is different in different geographies. And it's these, I don't know if the arbitrage is the only one, but these are opportunities for people to take advantage of financial systems to make a profit that you need to be aware of and identify in time to stop such holes.
And I mean, firstly, it's fascinating what you mentioned about consumers and the fact that actually, on the one hand, something like 3D Secure can be an inconvenience and lead to a lost conversion, someone that gives up. But on the other hand, in another country, that same inconvenience is seen as the stamp of approval that this is a secure, trusted website that you can buy from. So like you say, culturally, it can be different, even when you're talking about exactly the same thing, which is really interesting. And because both the consumer side and the regulatory side are perhaps a little bit linked to this question of ethics and what's seen as acceptable in terms of what data you gather, how you decide whether one transaction is approved versus another one. Do you see much in the way of kind of ethical constraints or challenges in what you're doing?
So first of all, us as a company, we're the guys that wear the white hats, right? So we're there to prevent the bad guys, the bad actors from being successful. So from that perspective, I think we're a do-good company for sure. True for everyone in the fraud prevention, industry. When it comes to using data and sometimes you can use data in ways that are not necessarily ethical, as you've mentioned. First, it's important to know that the regulation excludes fraud prevention from almost all the restrictions, right? So a merchant can provide us with any information we need as long as it's for fraud prevention purposes. So there's not a real problem legally, right? There's not a real problem legally or from a regulatory perspective, but there is an ethical problem. Let's say we've identified someone as a fraudster on one merchant. Are we now going to block him on any other merchant, even if it looks okay? Is that okay to do that? Is that ethical? And we've made many such queries, and to be honest, what we've decided is to try and be as strict as possible on being ethical. So if we're not certain there's a reason to do something, we're not doing it. And it's always a balance, because you can decide to use the information you have and share it in ways that are you can convince yourselves that they're doing good, but on the other hand, they're preventing, because you make mistakes, right? Let's assume we made a mistake on classifying someone as a fraudster, and now we're preventing him from accessing, 7 different services he's looking for. Who are we to do that to someone? So it's important that we put the restrictions around it, and that's what we've decided to do internally for us.
And how do you think consumers view it? Because I've often sort of thought that in theory, I could open up my Facebook account and my Twitter account and my LinkedIn account, and I could switch on location services on my phone. And in principle, these could all help prevent fraud, because, if I'm posting on Facebook that I'm in a cafe in Nottingham, then I'm probably not buying a car in Manchester. But at the same time, I think many consumers, almost the default position is, well, why should I share my data if I don't get a benefit? And often, because you mentioned there the pain of fraud for merchants, there is always an inconvenience. I mean, if your card gets lost or stolen, you have to get a new card. There's an inconvenience to it. But I think many people would say, well, I don't really want to share lots of personal data to save the bank or the merchant from some fraudulent transactions. I mean, how do you think people feel about that side of things?
I think it depends, right? I think it depends. Some things you can gather automatically. People don't, and people don't, usually they don't care about that much. Once you start asking questions, and if you ask someone for their age, for instance, right? That's an immediate turnoff, right? It's we've seen that happen, and we don't do that, right? We're not the merchant, so we're not asking for it, but we do monitor everything that happens, so we know what causes drops in traffic. So we can see that gathering information on one hand is helpful, for merchants to both to avoid fraud. But the reason consumers are reluctant to share that is not because they have fraud in mind, right? They just don't want to share the information because they said they're going to use it, right? They're going to use it. They're going to hunt me down. I'm going to see advertisement I don't want to see, right? That's what's going to happen. That's what prevents them from sharing it. If you share it for fraud prevention reasoning, people are happy to share. The issue is they know that you're not only doing it for that reason, and that's what creates, I think, the reluctance of people to share.
I suspect you're right that if it was only to be used for fraud prevention. I think most people would be happy to share most things. But I also think it's, because you mentioned this sort of behavior analysis earlier, I also think the sensitivity people associate with different personal data is quite varied. So I think face, a photo of a face, people are very protective of. But I would say location, age, name, relatives, address, these are all quite sensitive. Whereas probably how long it takes me to click on a button on a website, I think most people would consider that a lot less sensitive. And as you said earlier, still can be quite valuable for helping with fraud prevention.
Exactly. It could be as valuable as a fingerprint, but it's not as invasive.
So I really, in a moment, I want to come on to this question with you, Alex, of what you think the future is of fraud prevention. What might be happening? What disruption might we see? What radical changes could there be on the horizon? Before I come on to that, I do just want to remind people that if they want to get in contact with us on the podcast, you can drop us an email by writing to ndp-podcast@worldline.com. Always happy to have any feedback or suggestions for other topics that you'd like us to cover. And also, if you haven't already, please do take a moment to subscribe to the podcast and leave us a rating and a review. So, Alex, what are your predictions? What are your thoughts on the future of where fraud prevention is going?
So I think that there are two, I'd like to tackle two different angles that are not in any way connected. The first one is, where's fraud going? And as a result of that, obviously, where fraud prevention would go. And what we're seeing today is we're seeing more and more sophisticated fraud, let's call it that. So we're seeing a lot more social engineering being conducted. We're seeing a lot more mules that are being employed in order to acquire accounts that can be later used. We're seeing, and we're seeing social engineering means someone would convince you to do something that you think is a good thing. Actually, it's against your interest, and there will be, they'll get their hands on your funds because you've accepted to do something. And we're seeing that done at scale. We're seeing machines that are able to conduct social engineering. It used to be only people. Now we're seeing machines that are able to do that because the technology allows for that to happen. Fraudsters are utilizing it, and as a result of that, they are able to perpetrate fraud at higher scale and at better results for them. So we have to protect against that. And being able to protect against social engineering is very difficult because it means the actual owner of the card is actually conducting the transaction, is intending to conduct the transaction, and believes he's doing the right thing doing it. So identifying that that's fraudulent is not an easy thing. And identifying where he's coming from and why he's doing that and all of that requires even higher amounts of data and even more interesting ways of looking at it. So we're seeing that. We're seeing a lot of account takeovers and ability of the fraudsters to take over bank accounts or PayPal accounts. Something that was very difficult at the time is becoming easier and easier for them to do. So we'll see fraud going in that direction for sure, and we'll see fraud prevention platforms adapt to that and identify the means to fight that. One of the main things we're doing today, I believe that is difficult still within our domain, is really fight social engineering, fight what we call friendly fraud, fight account takeovers. The other aspect is where regulation is going to take all of this, and here I believe that regulation is gonna eventually get it back to the banks. Right? Today it's a merchant issue primarily, and I believe it'll change. It'll change because it should not have been a merchant issue from the get-go. I don't know if you know why that happened, and if I'm going too if I'm going too far back, tell me and I'll stop. But if you think about where the credit cards, how did that happen? What was the first thing that happened with credit cards? So think about the first credit card in the 50s in the US. It was Bank of America, if I remember correctly, that has invented the concept. They come to a grocery store, they tell the guy, you're used to people coming in with coins and notes, and they give you $10, you give them cheese, and they go their merry way. Tomorrow you'll see a person coming in with a plastic card that'll have numbers etched into it. We'll give you a couple of carbon copy papers, and we'll give you this machine. You do this funny movement with that would etch the numbers into the paper. You'll write down $10, you'll put that in your cash register, and you'll give them the cheese. And obviously the guy from the grocery store said, no, guys, you're making a mistake. I'm not releasing the cheese before I get the $10. I'm a retailer. There's no way I'm doing that. And they said, no, don't worry. We're a bank. We're governed by the state. We're adhere to regulation. If you have that piece of paper, it's the same as having a $10 note. You're gonna get paid. No questions. And by the way, if they didn't do that, the grocery store would never accept credit cards. No way. So they had to guarantee. They had to guarantee on the other side as well for the consumer, meaning if you as a consumer then lost your wallet, you would lose $100, $200, whatever you have in your wallet, right? Now that you have that plastic card, you lost your bank account. No one would carry their bank account in their pocket, right? So the only way for that to happen is if the credit card company says, no, don't worry. If you see a transaction that you didn't commit, it was not your transaction, you tell us, we'll refund. You're covered. They had to guarantee both ends. Otherwise, that entire payment method would not have been, it would not have been accepted, neither by consumers nor by the merchants. So that's how it started. Now, a couple of years later, the guy from the grocery store calls them and says, guys, I have a great client, David. He calls me every Tuesday. He places an order for like $1,000. And then he comes in on Friday at 2 p.m., rush hour, terrible time to come in. There's a long line. He stands in that line. He gives me that piece of plastic. I do that strange movement. I put down the $1,000. Why do we need to do all of that? We all understand. It's just a number. I'll ask him to read that number to me on the phone. I'll write it down on the same piece of paper you gave me. I'll put it in the cash register and it's done. It's all good. So the guys from the credit card company thought about it and they said, you know what? We prefer that you do that, right? Because otherwise, God forbid, he'll come in with cash. We don't want that to happen. So yes, we'd like for you to take the transaction, but only do that if you recognize the person. If you're certain that's him, if you know him, you recognize the voice, etc., take it, it's yours. We're not taking liability for these transactions. And they called it a card not present transaction. That's how it was born. And then 20 years later, internet, came to, and e-commerce, and the same story again. They call the credit card company and tell them about the internet and tell them about e-commerce and all of that. And obviously the guys there say, yeah, we'd like for you to take the transaction, but that's a card not present transaction. It's going to be on you. And that's how it was, bulked into these type of transactions, like on the phone or on fax, right? That was previously, these were transactions that happened on the phone or a fax. Now it became e-commerce. No one thought that e-commerce was going to be a $5 trillion industry. If they had, they wouldn't have allowed that to happen. And they would have left the problem of risk management with the banks because that's what they know how to do. The retailers have no idea how to conduct risk management. They don't. It's not their business. So, and we're now 20 years, 25 years later, handling that problem, creating a 10% problem on the entire industry, when if you look at the physical industry, it's maybe 0.5% of the problem, right? It's an order of magnitude more because it's not the right people handling it. So, in my opinion, 10 years from today, 20 years from today, it's not a 2 or 3 year horizon. It's a decade. It'll be a bank problem. It'll go back to the financial institutions. They'll need to conduct the same type of mechanism we're using today, right? The technology is the technology. You need the technology in order to be able to identify fraud, but it'll become a much more institutionalized facet of the business, in my opinion, than a merchant issue that he needs to find a way to cope with.
It's interesting you mentioned that. We had a recent podcast with Angelo Cacci, and he highlighted that actually a big part of any payment means or any payment instrument is this set of rules that governs liability, when the money gets transferred, what happens if there's a problem, how a dispute is resolved. So if we simplistically, you think a payment is just like a cash payment, and the hard part is getting the money from A to B. But actually, it's all the exceptions and that add the complexity. And I find it interesting as well because it could be regulations that change, but also it might be more an evolution of payment methods. And I have in mind, for example, Alipay, which essentially doesn't have chargebacks because the funds are not given to the merchant until the consumer says that they've received their goods. And you would intuitively think the merchants would be maybe unhappy with this because it's quite biased towards the consumers. But the feedback I hear is actually they prefer it to the constant threat of chargebacks and the overhead of dealing with chargebacks. So you could imagine that it might not be in 10, 20 years' time that we're even talking about cards and chargebacks and those types of disputes, but there might be alternative payment methods that just that manage it in a completely different way.
Yeah, you might be right. I think that it's difficult to see disruption in that in that magnitude that could make a difference, right? China is now a very different country from that perspective because of Alipay and WeChat, obviously. But I think that when you look at the Western world, these type of changes take a very, very long time, and we thought 3D Secure is going to make a change sometime in the beginning of the 2000s, like 20 years ago. And it's nowhere. It's nowhere, right? The industry is nowhere with that. So I think that for the Western world, it will take time. When you look at the mass scale, at the majority of the market, I believe it will take a very long time before we see that settle.
I really enjoyed this discussion, Alex, and I certainly learned a lot from it as well. And I think perhaps the most striking part was that reminder of the industrial level that fraud is now conducted with, and just how big that impact is, and that requires then a different approach to fraud prevention. I thought it was very interesting when you talked about the pattern matching and how that's a very clever use, I think, or application of AI that meets that specific challenge very well. And then I also think it was interesting to understand the different types of products that are more susceptible to fraud. And you mentioned instant delivery, digital products, and also you used the word liquidity, meaning ones that can be quickly and easily traded onwards to convert essentially that product back into cash in an account. And I think what also came across is that you then, when you look ahead, you apply a little bit the same, that fraud prevention will have to follow the trends of fraud, and fraud is becoming more and more industrial. And you mentioned social engineering. And of course, how often when I'm talking to a call center, am I starting a conversation with a bot? Everyone's heard of ChatGPT and with positive views and negative views, but of course those same technologies can be used to do social engineering more at scale and without requiring a human.
Already done.
Again, I mean, I do, whenever I have a podcast episode where we talk about fraud, I leave maybe a bit more scared than I was at at the start. But I mean, it is interesting to see that's the way it's going, and of course fraud prevention has to keep up with that. So Alex, I really want to thank you for taking some time to join the podcast and share your kind of rich experience and knowledge in this area with us.
Thank you very much, David. It's always a pleasure to speak about fraud. Obviously, that's my passion. So that's not a surprise, but I really appreciate the opportunity. Thank you.
And I'm certainly very glad there are people like you, the white hats, who are there facing that battle on a daily basis. And that just leaves me last of all to thank our listeners for joining us once again for this episode of Navigating Digital Payments.
Thank you for listening to the Navigating Digital Payments podcast, brought to you by Worldline. Join us next time to learn more about the latest innovations, trends, and predictions for the future of payments.